If you're a bond investor, the past few years have been extremely frustrating, exasperating. So what should you do? I've got a couple of alternatives to consider to help you diversify. That and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Conventional investing wisdom, long-term investing wisdom, has been diversification, right? Don't put all your eggs in one basket. Hold a basket, a mixture of large, mid, and small cap stocks and U.S. and international stocks and bonds. That's the mixture, right? And your CFP is going to help you come up with the right risk tolerance and approach for your financial plan and the right recipe. Now, diversification, sometimes when markets are at their most extreme and when fear is gripping the markets, all of those baskets tend to move in the same direction at the same time, which is down. And therefore, we recommend having multiple strategies. And that sort of fits in with the topic today. Because bonds have been a staple of that diversification. And actually, your allocation, again, conventional wisdom, your allocation or the amount of money that you have in bonds should be increasing as you get closer to retirement and in retirement. But the past few years, bonds have not held up their end of the bargain. This has been one of the most challenging time periods to be a bond investor. And so let me say it differently. One of the most challenging times to be an investor in retirement, right? And so you might look and say, well, the stock market's doing fantastic, but my portfolio really isn't. And it's because you've got so much in bonds. Over the past 10 years, the total return for the bond index, which operates a little bit differently than the stock index, and that's a topic for a different video, up just 14%. So that's 1.3% on average per year over 10 years. That's not keeping up with inflation, obviously. The past 5 years, the bond index is actually negative for the past 5 years when we know what's happened with the stock market. Again, extremely frustrating. So what do you do? To help, I would start by re-answering the question, why do you hold bonds in the first place? What's the purpose of bonds? Because I think just looking at those numbers and maybe tuning into your emotions, you might say, I'm done with these things. Well, what's the reason to hold them? It's not to make a big return, especially when the stock market's doing well. That's not how bonds function, okay? It's actually the opposite, to actually provide some stability when stocks are underperforming. And so you want bonds to show up when stocks don't, said a little bit differently. And while the past decade and certainly 5 years has been very frustrating for bonds and as a bond investor, I wouldn't say that it's failed in that. Stocks have done really well, bonds haven't. The issue is bonds haven't really shown up during some high volatility times like 2022 and even early in 2020 during COVID. Bonds struggled as well. And therefore, maybe it's appropriate to consider a few alternatives to help diversify some of your bonds into these so that it achieves that purpose of, well, when stocks are struggling or when stocks don't show up, I've got something that's adding to some stability in my portfolio. So couple considerations, work with your CFP on this. The first is individual Treasury bonds. Individual Treasury bonds. If you're using the bond index or a bond mutual fund, then you're going to see a lot of volatility. You're not sure exactly what your yield is. It's going to be shifting and changing. And your price move with your investment could be a little interesting, could be a little tricky. Instead of owning a mutual fund, a bond mutual fund, maybe complement that with holding an individual Treasury bond. Even though the Fed has reduced interest rates in the short term, we've actually seen longer term interest rates, 10 years, 20 years, even 30 years. Those interest rates have actually been very stable and have gone up a little bit. For a lot of folks that we're serving that are in retirement or on the cusp of retirement, we're diversifying or have looked at diversifying some of their bonds into a 10-year Treasury or 15-year Treasury, 20-year Treasury, something that is still paying a competitive rate of return, but something that if the stock market goes south, those bonds, we're just going to continue to hold them, and so therefore they should be fairly stable and predictable when we need them to. And then the other is hedging. And if you're a daily watcher and fan of the Wise Money Show, you know I've talked about this for quite some time. And again, you want bonds, or the original idea with bonds has been, well, show up, provide some stability when I need you to. And if you can offer a return, fantastic. And that's what the individual Treasury bonds would do, offering a fixed interest rate. But if you're looking to have, well, bonds really haven't shown up and stocks have, I want to own more stocks so I've got that upside, but I need something to show up when stocks struggle, when stocks are inevitably volatile and we have that bear market or that really rough patch. I need some protection there. Otherwise, it could cause me to make some really big changes to my investment portfolio at the wrong time or jeopardize my long-term savings. And that's where hedging could come in as well, allowing you to hold and be confident in the amount, the percentage that you have in stocks. But yet when stocks are really volatile and you need some protection, mathematically, protection is there. Protection has arrived via the hedging. So those are two alternatives to accomplish that purpose of why you've held bonds in the first place. Again, this isn't, you got to work with your CFP. So everyone's situation is a little bit different. And I wouldn't say, well, you've got to abandon bonds or really change everything, your entire approach or the approach that's been around for decades and decades. It's more about having more diversification, having more tools for your specific financial situation and financial goals. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.